Ind AS 28. Investment in associates and joint venture. What do you mean by associate? Associate is an entity over which the investor has significant influence. What is a joint venture? Joint venture is a joint arrangement where parties that have joint control over the arrangement have rights to the net assets of the arrangement. What do you mean by significant influence? Significant influence is the power to participate in the financial and operating policy decisions of the investee, but is not control or joint control of those policies. Significant influence may arise from voting rights, holding 20% or more of the voting rights. If an entity holds directly or indirectly through subsidiaries 20% or more of the voting power of investee, it is presumed that the entity has significant influence, unless it can be clearly demonstrated that this is not the case. Significant influence may arise from voting rights holding less than 20% of the voting rights. Also, in cases where the entity holds directly or indirectly through subsidiaries less than 20% of the voting power of the investee, it is presumed that the entity does not have significant influence unless such influence can be clearly demonstrated. Substantial or majority ownership by another entity does not necessarily preclude means exclude an entity from having significant influence. What is the accounting for investment in associate and joint venture? Accounting for investment in associate and joint venture in the books of investor. In case of separate financial statements, Ind AS 27 is applicable. In case of consolidated financial statements, Ind AS 28 is applicable. Equity method is used. Equity method. Equity method is a method of accounting whereby the investment is initially recognized at cost and adjusted thereafter for the post-acquisition change in the investor's share of the investor's net assets. The investor's P&L includes its share of investee's profit or loss, and the investor's other comprehensive income includes its share of the investee's other comprehensive income. Application of equity method. Under equity method of accounting, an investor shall pass following journal entries at various stages of investment. In case of initial entry to record investment done in associate, entry will be investment in B limited account debit to bank account. A recording of share in profit of the associate. Investment in B account debit to share in profit of investee. Share in profit of investee will be transferred to P&L account. A recording of share in other comprehensive income OCI of the associate. Entry will be investment in B limited account debit to share in OCI of investee. Share in OCI of investee will be transferred to OCI. A recording of dividend distributed by associate. Entry will be dividend income account debit to investment in B limited account. Dividend income will be transferred to P&L account. Equity method procedure. Calculation of goodwill or capital reserve and calculation of share in profit or loss of associate or joint venture. On acquisition of the investment, an entity shall identify the goodwill or capital reserve. Difference between cost of investment and entity's share of net fair value of investees' identifiable assets and liabilities is accounted for either goodwill or capital reserve. Goodwill, if cost of investment is greater than investor's share of investees' net identifiable assets, the goodwill is not separately presented. It is included in the carrying amount of the investment. Capital reserve, if the investor's share of investee net identifiable assets is greater than cost of investment, capital reserve is recognized directly in equity in the period in which the investment is made. Next, upstream and downstream transactions between the entity and its associate or joint venture. Upstream transactions are, for example, sale of assets from an associate or joint venture to the investor. Downstream transactions, example is sale or contributions of assets from the investor to its associate or its joint venture. The entity should eliminate unrealized profit or gain resulting from upstream and downstream transactions to the extent of its own share. When downstream transactions provide evidence of a reduction in net realizable value of the asset to be sold or contributed, or of an impairment loss of those assets, those losses shall be recognized in full by the investor. When upstream transactions provide evidence of a reduction in net realizable value of assets to be purchased or of an impairment loss of those assets, the investor shall recognize its share in those losses. Summary of equity method. Cost of investment should be recognized at cost, including goodwill if any. Add investor share of investee's profit or loss post acquisition. It will be recognized in investor's consolidated P&L. Add investor share of investee's other comprehensive income post acquisition. It will be recognized in investor's consolidated OCI, less distributions, that is dividends received from investee only to the extent of investor share. It will be recognized in investors consolidated P&L, less elimination of unrealized profit or loss resulting from upstream or downstream transactions only to the extent of investor share. It will be recognized in investors consolidated P&L, less additional depreciation due to fair value of investee's depreciable asset as on the date of acquisition only to the extent of investor share. It will be recognized in investors consolidated P&L, less impairment loss or reduction in NRV on downstream. Full need to be excluded. Less impairment losses or reduction in NRV on upstream. Only its own share of loss need to be deducted. It will be recognized in investors consolidated P&L. We will get the carrying amount of investment as on reporting date. An investment in an associate or joint venture is accounted under equity method shall be presented as a single line item in the balance sheet under the head non-current assets. Next, long-term interest in associates or joint ventures apart from equity investment. An entity might hold financial instruments in associates or joint ventures, which includes preference shares and other long-term receivables or loans, but does not include trade receivables, trade payables, or secured loans. An entity shall account such long-term interest in accordance with Ind AS 109. Certain requirements of Ind AS 28 also apply to such long-term interest, like allocating shares in loss of associate or joint venture to such interest. Next, in case of loss-making associates or joint ventures, if losses exceeds its carrying amount of investment, in addition to the equity interest, investor does not have any other interest in the investee. Then investor discontinues recognizing its share of future losses, further losses, and subsequent shares of profits of the investee is recognized by the investor only after those profits equals the share of losses not recognized. If losses exceeds its carrying amount of investment, in addition to equity instruments, the investor also have long-term interest in the investee, such as preference shares, long-term debts. In such a case, Ind AS 28 states that losses that exceeds the entity's investment in ordinary shares are applied to other components of the entity's interest, such as preference shares, long-term debts, and associates or joint ventures in the reverse order of their superiority. It can be explained by three-step process. Step number 1, apply Ind AS 109 independently. Apply Ind AS 109 such as impairment, fair value adjustments, etc., ignoring any adjustments to carrying amount of long-term interest under Ind AS 28, such as allocation of losses, impairments, etc. Step number 2, true up past allocations. If necessary, prior years Ind AS 28 loss allocation is trued up in the current year because Ind AS 109 carrying value may have changed. This may involve recognizing more prior year's losses, reversing these losses, or reallocating them between different long-term interests. Step number 3, book current year equity share. Any current year Ind AS 28 losses are allocated to the extent that the remaining long-term interest balances allows. Any current year Ind AS 28 profits reverse any unrecognized prior year losses, and then allocations are made against long-term interest. In case there are different reporting periods of entity and its associates or joint ventures, it will be discussed in Ind AS 110. Uniform accounting policies. If accounting policies are not same, then adjustments should be made to align the accounting policies of associate or joint venture to those of the entity. Exception number 1. In case of an associate, the adjustment for uniformity of accounting policy with those of the entity will not be done if it is practicable to do so. Impracticable to do so. That means if it is not practicable to do so. It is to be noted that this exemption is available in case of an associate only and not available for joint venture. This is because for an investor with just significant influence over an investee, it may be difficult to obtain necessary information to do adjustment for aligning accounting policies. However, in case of a joint venture, it would be relatively easy to obtain such information as the investor has joint control over the joint venture. Exception number 2. An entity may have interest in an associate or joint venture that is an investment entity. Such an associate or joint venture that is an investment entity may also have interest in one or more subsidiaries. When this is the case, such associate or joint venture, being an investment entity, would account for its interest in subsidiaries at fair value. Hence, in such case, the entity can elect to retain the fair value measurement used by associate or joint venture. Next, impairment losses. After application of equity method, it is necessary to recognize any additional impairment loss with respect to investors' net investment in associate or joint venture. There has to be substantial objective evidence of impairment. Objective evidences may include significant financial difficulty of the associate or joint venture, or the entity granting a concession to associate or joint venture because of its financial difficulties, disappearance of an active market for the net investment because of financial difficulties of the associate or joint venture, and significant or prolonged decline in the fair value of an investment in an equity instrument below its cost, breach of contract such as default in payments by the associate or joint venture, it becoming probable that associate or joint venture will enter bankruptcy or other financial reorganization, adverse effect in the environment, that is technological, market, economic, or legal, in which associate or joint venture operates. These are the substantial objective evidence of impairment. Impairment of goodwill included in carrying value of associate or joint venture. The goodwill on acquisition of associate or joint venture is recognized as a part of the carrying amount of net investment in associate or joint venture. Such goodwill is not tested separately for impairment. Rather, the entire carrying amount of the investment is tested for impairment as a single asset. Reversal of impairment loss. Any reversal of impairment loss is recognized in accordance with Ind AS 36, impairment of assets, to the extent that the recoverable amount of net investment subsequently increases. Discontinuing of equity method. An entity shall discontinue the use of equity method from the date when its investment ceases to be an associate or joint venture. Investment becomes a subsidiary. If the investment becomes a subsidiary, the entity shall account for its investment in accordance with Ind AS 103 and Ind AS 110. Ind AS 103 requires revaluation of the previously held interest in the equity accounted investment at its acquisition date fair value. That means fair value as on date of acquisition should be considered with the recognition of any gain or loss in P&L. Retained interest in the former associate or joint venture is a financial asset. Retained interest in the former associate or joint venture, that is a financial asset, shall be measured at fair value. The entity shall recognize in P&L any difference between the fair value of any retained interest and any proceeds from disposing of a part interest in associate or joint venture and the carrying amount of the investment at the date the equity method was discontinued. Reclassification of items recorded in other comprehensive income. On discontinuation of equity method, any share in the other comprehensive income of associate or joint venture that was previously recognized by the entity shall be reclassified to P&L. The above principle also applies in case there is a reduction in ownership interest in an associate or joint venture, but the investee still continues to be an associate or joint venture. In that case, The reclassification should be done in proportion to the reduction in ownership interest. Exemptions from applying the equity method. General criteria: an entity need not apply the equity method to its investment in an associate or joint venture if all the following conditions apply. There are four conditions. First one, the entity is a wholly owned subsidiary or is a partially owned subsidiary of another entity, and its other owners have been informed and they do not object to the entity not applying the equity method. Second, the entity's debt or equity instruments are not traded in a public market, that is a domestic market or foreign stock exchange, or an over the counter market, including local and regional markets. Third, the entity did not file, nor it is in the process of filing its financial statements with a Securities Commission or a regulatory organization for the purpose of issuing any class of instruments in a public market. Fourth, the ultimate or any intermediate parent of the entity produces consolidated financial statements available for public use that comply with Ind AS. If all the conditions are satisfied, then the entity need not apply the equity method to its investment in an associate or joint venture. Next, exemption available when entity investment is held through investment entity, where entire investment in associate or joint venture is held indirectly through a venture capital organization or a mutual fund unit, trust, and similar entities, then the entity may elect to measure investments in those associates and joint ventures as at fair value through P&L account as per Ind AS 109. When a portion of investment in an associate is held indirectly through a venture capital organization or a mutual fund unit trust and similar entities, entity may elect to measure the portion of investment in associate at fair value through P&L account as per Ind AS 109, regardless of whether the venture capital organization has significant influence over that portion of that investment. If the entity makes that election, the entity shall apply the equity method to any remaining portion of its investment in an associate that is not held through a venture capital organization.